Hello, everybody.
Yes, we're going to do retirement planning or retirement asset planning. And we're lucky to have you. You're one of the best presenters in this area. Well, you're one of the best presenters overall. I didn't mean to limit your the best. uh, but before we get started, I'm not going to ask you to pull up your Ask First form, but how long have you been in the business of estate planning?
So I graduated law school in 2000, and so I've been practicing this area for about 24 years.
And do you practice in any other area besides estate planning?
No, I don't, and I think that's important for all of you to consider. You want an estate planning attorney that is really focused on estate planning. I don't do family law or car accidents, and when you select an estate planning attorney, you should have someone whose focus is really solely in this area.
Yeah. One of the topics there's going to be today, it's going to be kind of in an area what I think that most attorneys don't get themselves involved in. And I want you to speak on that, but it doesn't have to be right now. But let's go for, first of all, Michael could do all 6 sessions of the estate planning course. So I have asked him specifically just to focus on this area because he's just especially good and focuses in his practice in this area. But let's talk a little bit about your general practice. How do you charge your fees?
So I charge in two different ways. The first way is for our standard estate planning, we do a flat fee or a fixed price. And in sometimes, if it's not going to be a standard situation, we charge by the hour. If I can take a minute, I'll explain to you how the flat fee services work. What we do for you is doing, of course, your will and trust, power of attorney, and healthcare directive. But we also focus on, in this flat fee, getting your beneficiary designations done. And that's going to be the topic for today, or part of the topic, and how important these documents are and your retirement accounts. And as you were mentioning, Pete, that sometimes this gets overlooked in the estate planning process, and I will address that. But we like to pack a lot of extra value in our flat fee program. So we do try to do your beneficiary designations for you, and you'll see the value of that in a second. We, of course, do a deed for your primary residence, include notarizations, but we also like to spend a lot of extra time with our clients. And what I mean by that is that I like to spend an hour or 2 hours with my clients designing their estate plan. And then at the end, instead of just mailing the documents to you and hoping that you sign them correctly, we have you come back in the office. I page the documents with you, supervise the signing, because we want to make sure those documents are signed properly when it's time, when you need them in a time of need. So all that takes a little extra time, but we think it's worth it with the end result. So for a single individual, we're probably around $2,800 to $3,300 for all of that. For a married couple, is probably more like $3,800 to $4,300. Now, having said all that, if we have a complicated situation where we are disinheriting children or doing some extensive estate tax planning, we don't know how long that kind of engagement is going to last and what will be involved in it. So we charge by the hour. My hourly rate's $450 an hour, and my paralegal rate is $175 an hour.
Okay. And then do you give a free consult to someone who doesn't know you and doesn't understand what they need?
Sure. I'm happy to provide a 30-minute consultation. You can come into the office, or we can do it over Zoom or the phone. Can explain the process of estate planning, or if you have an existing estate plan, I'm happy to take a look at your documents, and we do that complimentary basis.
Wow. That's really special because very few attorneys provide that. So thank you, Michael. I really appreciate that. Are you connected with anyone who sells annuities, insurance, or financial products?
Absolutely not.
Not, yeah, I know you don't, but people forget to ask, So your only source of income is your client, and you're only beholden to the client to do what's best for him.
In a fiduciary manner.
Yeah. One of the things that people always ask is that, hey, we do our estate plan and I need to update the estate plan maybe sometime in the future. If I call you, is there a charge?
Well, generally, I'm pretty lax on the billing. And if I do someone's estate plan and 6 months later they have a question about how to update their beneficiaries or something simple, I'm happy to answer that question. And I don't normally charge for that. If it's something substantive and you really need legal advice, then we do charge on an hourly basis. And I
Well,
did notice there was one question about what about updating just a healthcare directive or your
yeah.
documents. And I think that's worth pointing out that a lot of times when you change attorneys and you say you want to just update one small thing, it ends up being a lot more than just one thing. So for example, if you're going to update a healthcare directive and you have somebody, you want to change the order of the people you're appointing, they also might be your trustee. They might also be your power of attorney or attorney in fact. And so sometimes it ends up to be extensive. And the other issue is that when you come in here to update things, the attorney that does the update is responsible for all the documents. And sometimes it's more effective simply to redo the documents, especially if they're older. With one caveat is that we can do something called a restatement. So we don't have to change the title of all your assets. We can keep the name, but we can replace the document with updated documents that have new legal terms in them and have all the new terms that you would want.
Well, just the idea of having to change a trustee, if it's a husband and wife, so you're having to change the usually the advanced healthcare directive, the will, and the trust itself. So that's 3 documents.
Plus the
Then
power of attorney.
and the power of attorney, and then you got to change for the partner, for the so that's 6 documents just for one, what you would consider a small change. So always ask, this is what I need to do, approximately what will it cost me when you talk to legal counsel. Let's get into the program, Michael. You've got a fabulous outline. I recommend everyone to thoroughly understand it. And Michael, you take it away.
Great. Well, first of all, I want to say I'm happy to be here. I think I have a lot of important information to share with you today. And I'm also happy that you're all here because with a name like retirement account planning, we're afraid that we're going to turn the Zoom on and no one's going to show up. So I'm glad you're here. Also, this is a really important time for retirement accounts. And what I mean by that is that there have been some really significant legal changes in the law over the last few years. And so you're here to listen to this presentation at a great time. Now, as far as questions, we have allotted some time for questions at the end, and of course, you can put questions into the Q&A. And don't be shy on the questions. I know I'm an attorney, but I can't find you through Zoom and bill you, so don't be shy. Ask all the questions that you want. I'm going to skip my bio and my ask first, and I'm going to get to the beginning of the presentation and talk about what we're going to learn today. And as I just mentioned, you're going to learn about the latest rules that affect retirement accounts. And this includes the brand new Secure Act that went into effect at the end of 2019. There were 250 pages of regulations in 2022 trying to explain how we do the Secure Act or enact it. There was another Secure Act 2.0, at the end of 2022. And just a few weeks ago, another notice that's really important that you know about just on April 16th, 2024. So you're going to be up to date, and we're going to cover all of those things. We're also going to talk about how you calculate your required minimum distribution. That's called your RMD. And if you don't know what your RMD is, no problem. You're in the right place. You're going to learn it today. We are also going to cover your options for choosing beneficiaries for these retirement accounts, how we fill out this beneficiary designation form. We're going to cover that also. We're also going to talk about whether the stretch is dead or alive. And again, if you don't know if the stretch is dead or alive, then you're in the right place. We've got you covered. We're going to explain it to you today. And lastly, to end the presentation today, we're going to talk about information about Roth accounts. They do have a different set of rules, so we've saved them for the end to explain them separately. Now, what are we talking about today? We are talking about retirement accounts, but what are retirement accounts? And when I say retirement account, this morning during this presentation, I'm talking about your IRAs, your 401ks, your 403bs, pension plans, etc. That's what I mean by retirement account. So if I say retirement account, think IRA or 401k that you might have. As I mentioned, the Roth IRAs do have a separate set of rules, so I will cover those at the end of the presentation. Now, why do we care about these retirement accounts? Well, the first reason is that the contributions that we make to these retirement accounts are tax deferred. And what I mean by that is that you get an immediate tax break. If you make, I don't know, $50,000, but then you put $5,000 into a IRA account, well, the good news is you get an immediate tax break on the $5,000 and only have to worry about paying taxes on the $45,000. Now, the Secure Act is sort of our first introduction to it. There was an old rule that you had to be under 70.5 to make contributions. Excuse me. There was a limiting when you could make contributions, and the old rule limited at 70.5. Now there is no age limitation. If you do have earned income, you can still continue to contribute to these retirement accounts, including IRAs. Now, the second point, and probably the more important point, is that after you make the contribution to your retirement account, there's no income tax or capital gains because these accounts are tax deferred. And we don't have to pay taxes every year on the growth of this money and the income on this money. And this creates this amazing, significant compounding effect that we can't really get in a taxable account. So money grows efficiently inside these accounts. And with that, maybe you remember the number, Pete, but do you any idea how much might be in these retirement accounts all total at the end of 2024?
Yeah, I was flabbergasted by the number that you had mentioned before. So I'm repeating what you have mentioned in the past, but I thought you said somewhere around 38 trillion.
Oh, you have a good memory. That's exactly right. $38 trillion. That's up about $18 trillion since 2010. So a tremendous amount of money that are inside of these retirement accounts. And with that, I want to remind everybody that most of all of this money in these retirement accounts, this $38 trillion, is pre-tax dollars. Remember, when we put money in there, we didn't pay taxes, and all the growth in there haven't been taxed. And so my question to all of you in the audience is, do you think the IRS wants a piece of this action, of this untaxed money? And of course, I hope everyone is shaking their head yes, but unexpectedly, or maybe for some of you, would they even take the tax after you die? And unfortunately, the answer is yes. And in fact, under the new Secure Act, which you'll learn a little bit more about in a few minutes, they're going to get it faster after you pass away than we ever expected. And this last point right here, that this money, remember, it is not tax-free money. It is only tax deferred. And some people say, or look at this saying that, the IRS really has a mortgage on these accounts because they're going to get their tax generally one way or the other. When you see $1 million in an IRA account, you should adjust your vision and maybe only see 500,000 or 600,000 because the taxes are usually going to get paid and the IRS gets their share one way or the other. Now, Peter started to make this point, and this is the last point before we start to get into the substantive material, and that is that sometimes retirement accounts can be our largest asset of a person's estate, but they are often missed or overlooked in the estate planning process. People get focused on doing their will and their trust and their power of attorney and healthcare directive, and they forget about the importance of treating or dealing with these retirement accounts and doing what you will soon learn about, your beneficiary designations. So the takeaway for this slide is when you do your estate plan, don't forget what I think is the fifth pillar. Along with your will, trust, power of attorney, and healthcare directive, consider the fifth pillar, your beneficiary designations for retirement accounts and insurance.
Michael, talk a little bit about that. Can married couples, for example, get into each other's IRA account, and what document would they need if they cannot?
Sure. So I know that hopefully most of you have seen some of the other presentations, and one of the things that's really important is looking at the title of these accounts. And generally, we like to have many assets held by our trust, and those things are dealt with by our successor trustee. But in the area of retirement accounts, these are accounts that usually have to stay in the owner's name. IRA stands for individual retirement account. And with that said, they're not covered by the trust. So we need a backup document if you become sick or incapacitated, and that document, as you may have learned, is called a power of attorney. And this is really important. We use the power of attorney quite often for IRA accounts because when it's time to deal with these accounts and perhaps you're sick or incapacitated, a spouse doesn't have a right to get into it. You need the legal document called the power of attorney.
Thank you.
Okay, with that introductory discussion, I'm going to start my substantive material about talking about the rules for these accounts during your lifetime. While you guys are alive, how are the owners treated? So the first thing I want to talk about is if you're alive and you want to take money out of your retirement account, but you've not reached the age of 59 and a half, then unfortunately you're subject to a penalty. It's a total of 12.5%, 10 Fed, and 2.5% California. But remember, that's a penalty. It doesn't include the additional income tax that you need to pay on the money. Remember, this money hasn't been taxed, and as you pull this money out, it's subject to your regular income tax. So let's say you're at 30% federal, 10% state, then we add the 12.5% penalty, so we can get easily, in many cases, over a 50% tax when we're withdrawing money early from these accounts. If you do make a withdrawal, you get something called a 1099-R. You take that, report the income on your tax return, as well as calculate the penalties. Now, the good news in some ways that if we do have to access this money before 59 and a half, the money that's in these retirement accounts, then there are a number of exceptions. In fact, there are over 20 exceptions to the penalty. Secure Act 2.0 added some other interesting ones. People under 59 and a half that are victims of domestic violence or have a terminal illness or have long-term care expenses. These are some of the special exceptions that have been added to avoid the penalty for withdrawals before age 59 and a half. Now, after the age of 59 and a half, but before you reach the age of 73, and that isn't a typo, it's not 7.5 and it's not 72, you may, but you are not required to withdraw money from these retirement accounts. Again, since you are over 59 and a half, we don't have to worry about the penalty, but we do have the tax. You do get that 1099-R, and you have to report your withdrawals from these retirement accounts on your tax return. Now, where it starts to get interesting is when you turn 73, and again, that's not 70 and a half or 72, the law requires you to start to withdraw money from these retirement accounts. And under the Secure Act 2.0, they changed the withdrawal age, and many of you might be familiar with the 70 and a half requirement. Well, that was eliminated, and then they moved it to age 72, and now they've moved it to age 73. And by the year 2033, it's going to slowly creep up to age 75. And again, this is the year in which the IRS says to you, it's time, or you are required now to start to make distributions from these accounts, whether you want to or not. Now, this is referred as an RMD, a required minimum distribution. Again, no penalties because, of course, we don't have, we're over the age of 59 and a half. And but the distributions are still subject to our regular income tax. And to understand what this RMD or required minimum distributions are about, we really have to just understand that the IRS is saying to you, we've given you a tax break long enough. You're now 73 years old. You've got to defer the taxes and get all these great tax breaks for all of this time. And the IRS is saying it's now our turn. You're 73. We want you to take a little bit out every year for one simple reason. We want to collect some money. We want to get some taxes. Now, with limited exception, everybody starts these withdrawals at age 73. Again, the required withdrawals. And we do have to recalculate every single year and then withdraw the money before December 31st. Now, there is something we call the first year rule that you should be aware of. And that first year rule says that in the year you turn 73, if you would like to, you have an option to delay your distribution until April 1st of the following year. So a little extra time for the year you turn 73. But watch out, this can often be a little bit of a tax a trap for many of our clients because, for example, if you turn 73 this year and decide to take advantage of this rule and delay your distribution until sometime before April 1st of 2025, you will do a distribution in 2025 for your 2024 distribution, but you also still need to do your regular 2025 distribution. And what ends up happening is you have two distributions in the same year. We call that bunching of income, and that can push you into a higher tax bracket sometimes because, again, we put the two distributions in the same year, sometimes causing higher taxation of Social Security benefits, maybe higher Medicare premiums. So many of our clients find out that this isn't a great deal, and they would rather spread the distributions over two taxable years to end up with a better tax result. So make sure you run the numbers on this if you're going to look at taking advantage of this first year rule. Now, a couple of the things to talk about this required minimum distribution, and that is that you can always take more than the required amount. And I'm going to show you how we get the required amount, the calculation, in just a second. But let's say you do your calculation and you need to withdraw, I don't know, $5,000, and you decide you want to take out 10 that year. That's no problem, but you don't get any credit. There's no carry forward, and you still have to recalculate and take a distribution the next year. And as far as the penalties are concerned, the IRS is pretty serious about that. In fact, up until the Secure Act 2.0, the penalty was 50%. That's 50. So a pretty hefty penalty. Luckily, under Secure Act 2.0, they decreased the penalty to 25%. That's still a pretty hefty number. And that penalty applies if you don't follow these rules and leave money in a retirement account that you were supposed to distribute. It's a 25% penalty. They do have an option to do a correction and then maybe only reduce your penalty if it's done in a timely manner to 10%. The bottom line is the IRS is pretty serious about you following these rules. We don't want to pay any of these large penalties.
Yeah, Michael, what happens in for some of my clients who are in assisted care facilities or board and cares, they're up in years and they have a fairly large IRA account, then because we have a very major medical deduction, it's a great opportunity for us to take more monies out of the IRA account since we have an offsetting deduction. But as you say, you got to run the numbers. You got to know what income tax bracket you're in because all of that money comes out as ordinary income.
Yeah, that's right. Now, the good news about calculating these required minimum distributions is that most banks and brokerage firms or your employer, if you're still working, or your former employer, will do the calculation for you and send you a letter when you turn 73 to tell you what their calculation is for your RMD. Now, you can do this calculation yourself using an IRS table, which I'll show you in a second. And I think it's important for you to understand how the calculation is done and maybe even check the work of your bank or brokerage firm to make sure that it's right. As I mentioned, you do have to do this calculation every year. And all that is required to do this calculation, this required minimum distribution, is you take the prior year balance of your retirement account, divide a number that is off an IRS table, which I'll provide to you in a minute, and also some references to it. You divide those two numbers together and you get your RMD. So it's pretty straightforward. Let me show you part of this table I've been referring to. Most of us use what's an IRS table called the uniform table. And I'm going to give you an example. Let's say you're turning 73 this year. The IRS says that your divisor for this calculation is 26.5. If you were 80 years old, the number would be 20.2. So let me show you how this works for somebody who's turning 73 this year. I'm going to pretend I have a hypothetical balance for my 73-year-old of $100,000 at the end of December 31st of last year. I go to that table. I got my number 26.5, and then I divide the numbers together, and it gives us our balance or our required minimum distribution, and that number is $3,773.58. That's all there is to it. It's pretty easy. So that's all there is to do the required minimum distribution calculation.
I love this chart, Michael.
Yeah, this is a little bit more of that uniform table. And what I've done is I have added this column both sides here, which converts this number, this divisor the IRS is telling us, and converts it to a percentage so you can get kind of a sense of what the IRS is asking us to do at particular ages. So we just did 73 and it was 26.5. The IRS is basically saying you need to make a 3.78% withdrawal. That's a pretty generous, low number. Prior to 2002, we had some really steep numbers here that caused a high withdrawal rate for required minimum distributions. But under this table, it's very forgiving. I'll jump to age 80 again. That's a number of 20.2 that requires a distribution of 4.96%. That's a pretty reasonable number. I mean, you could have a portfolio this year that might have grown more than 5% or 4.96%. So you could do your withdrawal and still have more money in your retirement account than you did after the withdrawal. So pretty nice table or generous table in that respect. Now, these numbers are actually your life expectancy. So you can see if you make it to 100 years old, the IRS says you're going to live 6.4 more years.
It's always good news. The other thing too is that when we have to withdraw from our IRA, we're looking at a specific dollar amount. So seeing the percentage, I think helps because it is such a small percent, and many individuals earn more annually than the withdrawal rate.
That's right. Now, that divisor that we were looking at, again, was from the uniform table. And most of us all use this uniform table. There are some exceptions. One exception is that if you have a spouse that is more than 10 years younger than you are, then there is another table to use. All these tables are available in IRS publication 590B, available on the internet from the IRS. And they have all the tables that you're going to need. Again, most of us use this uniform table. All the tables were effectively updated January 1st of 2022. So if you're looking at tables, just make sure you're using the one that was updated January 1st, 2022. Now, one other rule that's kind of helpful in this area of required minimum distributions, and unfortunately only applies to IRA accounts, so it doesn't work for 401ks and 403bs, etc. But if you have more than one IRA account, you can calculate your RMD separately for each of those accounts, then combine them all and take it out of one account, and it will still satisfy distributions for both accounts.
If
And where
you
this comes in handy is, for example, let's say you have two IRA accounts and one is fully invested with stocks or bonds that don't want to be disturbed, but it's time to do your RMD. You don't really want to sell those items. So what you do is you calculate your RMD on both of those accounts, come up with your number, combine them together, and maybe you have a second IRA account that has only cash in it. Well, you can take both the distributions out of one of the accounts and satisfy your RMD for both accounts. So kind of a handy rule for some of us who particularly don't want to disturb investments in particular IRA accounts.
Michael, if I have a 401k account and an IRA account, can I take my 401k required minimum distribution out of my IRA?
No.
Okay,
So
so I have to take it out of the 401k.
unfortunately, the rules for sharing distributions only apply among IRA accounts. You will have to do a separate distribution out of a 401k.
Okay. And so if somebody's been taking distributions from their 401k prior to reaching 73, they just need to continue doing that all the way through if they're after the age of 73.
That's right. So if you've been taking distributions before 73, as long as those distributions meet the RMD calculation, you'll continue to do them.
And what age? Somebody brought up a good question. Is that we all are two ages every year? Is it the age that we are at January 1st of every year?
If your birthday falls anywhere, the 73rd birthday, anywhere during the tax year, you are now qualified, even if it's on December 31st or January 1st, it's your year.
Okay.
Now, one other thing I do want to talk about, a really handy rule about how dealing with these accounts again while you guys are alive here, and that's the qualified charitable distribution rule. We sometimes call this the QCD to shorten it. But basically what it says is that you can make distributions from your IRA account directly to your charity and not have to, or more specifically, get to exclude that income from your tax return. And again, this is called the qualified charitable distribution rule. It has a long history of expiring and the tax law being temporary and then being put back in retroactively. The law is now permanent as a tax law can be, so it is part of the tax code. And more consideration needs to be given to it now under our current tax laws, which I'll explain in just a minute. And the best way to understand the qualified charitable distribution rule is to understand how it worked before we had this rule. And again, without the qualified charitable distribution rule, if somebody wanted to use some of their retirement account to give to a charity, for example, an IRA, what they would do is they would take a distribution from their IRA. They would have to count that on their tax return in their adjusted gross income, but then they would turn around and write a check to a charity and hopefully get a charitable deduction so that we would net to zero. But unfortunately, it didn't really work out that way, particularly for taxpayers who don't itemize. Remember, if we don't itemize, we don't get a charitable deduction. So we would have taxpayers who were accepting this income on their tax return and getting no corresponding tax deduction. And this is more important today because many of us don't itemize anymore. Under the current tax law, they've raised what we call the standard deduction, which is the other option taxpayers have each year to either list all of their deductions and total it, or take just one fixed standard number. And because that standard number has increased to such a large amount, many of us, when we total or itemize, it's better to take the standard deduction, which means we don't get charitable deductions. So this is important. In addition to that, even when we get a deduction, counting this income in our adjusted gross income caused other problems, including higher taxation of Social Security benefits, increased Medicare premiums, other deductions that were tied to our AGI. Again, this is all under the old rules. The good news is the qualified charitable deduction sort of came to the rescue, because when you do a distribution from your IRA to a charity, we get to exclude that money from your income tax return. It doesn't affect your AGI, and all the problems that we had in the previous slide don't apply anymore because they were cured by this distribution rule. And get this, which I think is really interesting, and the second point here is that even though you get to exclude this money from your tax return as income, it still counts as your required minimum distribution. So let's think about this for a second. Let's say that we were going to do a $1,000 charitable donation to the Segerson Center, and we're going to write a check out of our checking account at the end of the year, and we're excited about that. Well, normally, because we're taking a standard deduction, most of us, we don't get any charitable deduction. So maybe this isn't the best way to do it. What about doing it out of your IRA account, doing a qualified charitable distribution? You call your bank, your brokerage firm, you tell them that you want to make a qualified charitable distribution. They'll send $1,000 to the Segerson Center. It doesn't count on your tax return for income, and if it will count towards either satisfying or partially or fully satisfying your required minimum distribution. Make sense? Now, the rules about this qualified charitable distribution is that you can only do, I say only, it's limited to $105,000. That number is indexed to inflation, is going to change every year. But that's the maximum amount that the IRS will allow you to give to a charity from your IRA account. You can do, of course, less, $500, $1,000, anything that you want. You do have to be 7.5 years old, and the distributions have to be made directly to the charity. And what I mean by that is that it has to be made out to the charity. Some institutions send it directly to the charity. Sometimes they'll tell you it's okay to come pick it up the check and the check is made out to the Red Cross or the American Lung Association, wherever it's going to be, you can pick up the check, but it does have to be made directly to the charity. One issue that we've had in the past is that if the institution is mailing it, it sometimes doesn't have your name on it, and the American Cancer Society gets your check and they have no idea where it came from or who made the donation. So watch out for that. Now, the last point on this slide is that the Secure Act also added some interesting rules for the possibility of taking qualified charitable distributions and putting them into something we call split interest entities. Now, it's limited to only $50,000. And I believe that you guys already discussed charitable remainder trusts and gift annuities, but you can do a qualified charitable distribution to those type of entities. Then you get some income back. But again, it's only limited to $50,000.
We're going to be talking about that next week, Michael.
Oh, next week. Okay, great.
Yeah, and and it's too small of an amount for a charitable remainder trust, but it's definitely something to consider for a charitable gift annuity. And we'll talk more about that next week. It's actually a really nice idea, but you can only do it once in your lifetime.
That's right. Now, the Secure 2.0, our most recent Secure Act, had a lot of interesting provisions in it about sort of providing flexibility and promoting retirement savings. But there were a number of interesting things that were not in it. One of the things that we thought might be in it was closing down what is referred to as the backdoor Roth, where you use a technique to get money into a Roth account that you wouldn't normally be able to create. In fact, the reason Congress is so upset about this, one of the founders of PayPal, Peter Thiel, used this methodology to get some of his stock into a Roth account. And he now has $5 billion tax-free dollars inside of his Roth account, but they didn't touch it. Secure 2.0 didn't make any changes, and that technique still exists. And the bill didn't, and we're going to talk about this, answer some questions about how these accounts are treated after death and what kind of distributions are required. But the good news, on April 16th, they issued this notice 2024-35, which we will be talking about in a minute, that does answer this question. So we'll get to that in just a second. So with that, those are the rules during life. Now what we want to talk about is choosing beneficiaries and how these accounts are treated after you as the owners pass away. And ladies and gentlemen, this is where it gets a little bit challenging. The IRS
I have my coffee out, Michael.
That's right. I was going to say, if anybody has a cappuccino machine at home or something, or an espresso machine, go ahead and press that button. The IRS doesn't make it as easy as they could in this area, and there's lots of rules. I've tried to make this as simple as possible, and in fact, I've come up with these 5 concepts that I want to go over. And by going over these 5 concepts, I think you'll better understand how these accounts are treated and how we pick beneficiaries for them that receive these accounts after we've passed away. So jumping into it, the first concept, rule number 1 or concept 1, is that during your lifetime, you get to pick a beneficiary for these accounts. You fill out this beneficiary designation form that is available from our bank's brokerage firm, your employer, former employer, etc. And you fill that form out and submit it. Now, the good news is by filling out that form, because you've done that beneficiary designation form, that is a contract to pay on death, and we get to avoid probate. So that's good news. The other good news is that you can change this beneficiary designation form anytime that you want to. You just fill out a new one and submit it. There used to be rules back in the day that limited when you could change these. Those rules are now not applicable. The latest dated one is the one that will control what happens to this retirement account. And this may be one of the most important points of today, because there's some misunderstanding out there. It is this beneficiary designation form which will control what happens to that retirement account. It is not your will. It is not your trust. And some people have a misunderstanding that because they did their will and their trust, that somehow they took care of their retirement accounts. And that's not correct. We do have to fill out this form. This form is so powerful, it actually supersedes your will and trust. And if you have an IRA account and you list your sister or your brother as the beneficiary, but then your trust says, I want everything going to my children, well, the beneficiary designation form supersedes and will control what happens to this account. Okay. Concept 2 is that at death, our designated beneficiary, the one we wrote in on this designated beneficiary form, has an opportunity to defer income tax until the money is actually withdrawn from this retirement account. The third concept is, of course, the IRS still wants their share, and even after you're gone, they're going to require our named beneficiary to take money out of this account. So again, as always, the IRS can collect the tax. With that in mind, the fourth concept is that from a tax standpoint, it is preferred that your beneficiary not take all of the money out in one lump sum distribution shortly after you passed away. In a few minutes, we're going to talk more in detail about the problems with doing lump sum distribution. But as a concept, the idea here is that we want our beneficiaries to take advantage of this deferred tax environment. And if we take it out in one lump sum, we lose that opportunity for it to grow tax deferred, and likely they'll pay the highest tax break because they're taking all of the income in one lump sum in a single year.
Yeah.
And again, I'll talk about that in a minute in more detail. The fifth concept here and the last concept is that generally then our strategy is to try, and I should have put that word in quotations, to make our beneficiaries' withdrawal period as long as possible. And before the Secure Act, we had the opportunity of naming beneficiaries, maybe children or grandchildren, and they had the ability to do what we called stretching their retirement account, generally your IRA account, and we could create decades upon decades of tax deferred growth. The money and the calculations, the amount of money that could grow to was staggering. But unfortunately, the IRS sort of caught up with us, and the Secure Act, in essence, eliminated the ability to do a stretch. And so the answer to one of my questions at the beginning is the stretch dead or alive? And
It's
although
dead.
there are some exceptions, the stretch is pretty much dead. And the general rule is, starting in 2020, is that with exception, almost everybody, except for some individuals we'll talk about in a minute, have only 10 years to empty this account. So if we have, for example, an adult child or a sibling or something like that, and they inherit that retirement account because they were listed on a beneficiary form, they're going to have a 10-year window to withdraw the money, and the money account must be emptied by the 10th year. Where things got really confusing, and this is where you need your espresso, is that we understood that rule to say that if you inherit an IRA account and you weren't an exception, you had to abide by the 10-year rule, and you had to just simply empty the account, do anything you want for the 10 years until, and then empty it in the 10th year. What ended up happening is that in the regulations, there was some discussion about, well, maybe if the owner, meaning you guys, were already 73 and already taking your required minimum distributions, maybe that meant that our beneficiaries then had to take distributions. And there were a lot of confusion about that. And basically the rule as it is at the moment is that if someone passes away and they are not 73 and not taking the required distributions, then our beneficiaries, again, if they're not one of our exceptions, has 10 years and they can do anything they want, take nothing out to the 10th year, whatever they want to do. However, if you are over 73 and you pass away, our 10-year rule still applies, meaning it has to be emptied by 10 years, but you have to take your own life expectancy, that is the beneficiary's life expectancy, and take a little bit out every single year. And if this sounds crazy and confusing, it was, nobody understood it. So in April of this year, April 16th, they issued this regulation, or excuse me, notice 2024-35, which said basically, sorry, we know this was super confusing. We're giving everybody a break because nobody understood the rules. And if you didn't do this and you have an inherited IRA and you didn't follow the rules properly, you get relief through 2024. But starting in 2025, they're expecting us to follow the rules until perhaps they change them again. Now, I've been talking about this 10-year rule. Well, not everybody is susceptible to the 10-year rule. There are exceptions, and they are called eligible designated beneficiaries, EDBs. And EDBs include, for example, surviving spouses. If we name a spouse, we don't have to worry about the 10-year rule. If we name a child that is not in age of majority, then we don't have to worry about the 10-year rule. For a little while. As soon as they reach age majority, then they're susceptible to the 10-year rule. We don't have to worry about the 10-year rule for disabled or chronically ill beneficiaries, as well as individuals that are not more than 10 years younger. So if you're not an EDB, one of these 4 categories of people, and we name, for example, an adult child or an adult grandchild or another individual, then we're stuck with the 10-year rule. So with those concepts and rules in mind, you can see how important it is on how we fill this form out and who we choose to select to be beneficiaries on this beneficiary designation form. And that's what we're going to talk about now, filling out that form and who we might write in as beneficiaries for our retirement accounts. And I've broken it down to about 5 categories: spouses, children, grandchildren, or other adults, possibly naming a trust as a beneficiary, possibly naming a charity as a beneficiary, or maybe we do some combination of those other 4 categories. And what I'll do now for a few minutes is talk about each of these separate categories and the advantages and disadvantages of each. So the first category I want to talk about are spouses as beneficiaries. Now, if we name a spouse on our beneficiary designation form and you pass away, the good news is the money is available immediately to the spouse. As we just talked about, they are an exception to the 10-year rule, so we don't have to worry about that. And they have a special rule that only spouses as beneficiaries have, and that's called a spousal rollover rule or a spousal rollover option. And many of our clients take advantage of this rule if we're going to name a spouse as a beneficiary. And I have a slide here which kind of illustrates how this works. You have an IRA account in this example. It could be a 401k or 403b. You've named your spouse as the primary beneficiary. If you pass away, your spouse can actually create a brand new IRA in his or her name, in the surviving spouse's name. We can move all of your assets in your retirement account to his or her new IRA account, and the account gets treated as if it was the surviving spouse's account all along. Meaning if the spouse was under 73, there's no required minimum distributions. The spouse can pick brand new beneficiaries for the account, younger beneficiaries, of course, so that we can get further tax benefits. And in addition to that, the Supreme Court a number of years ago said if you do this spousal rollover technique, you can get a little bit higher creditor protection for our surviving spouse's new IRA. So again, a lot of
Michael, in some families that are, second, third marriages,
yes. In fact, that's I think what you're about to point out is that this doesn't work for everybody. So one of the disadvantages of naming a spouse and perhaps doing a spousal rollover is, as you were just saying, Pete, what if you have a blended family? What if you're worried that the spouse is going to change a beneficiary to somebody that we don't want? So naming a spouse may not fit every circumstance, and so we need to watch out for that. Now, another possibility is naming children, grandchildren, or other adult beneficiaries as beneficiaries on these beneficiary designation forms. Now, minors children are exempted, and this is only for children from that 10-year rule. But as I mentioned, as soon as they turn 21, the 10-year rule starts to go or starts to tick. But I want to make sure we're clear. We really don't want to name minors as beneficiaries on accounts, whether it's children or grandchildren, etc. a child or a minor under the age of 18 doesn't have a legal signature. So a lot of times we have best intentions of leaving retirement accounts to minors. We don't want to do that outright. We have other ways to do it, which I'll talk about in just a second. So watch out for that about naming minors on a beneficiary form. Now, for adult children, again, ones that do have signatures because they're over the age of 18, we can name those individuals as beneficiaries as well as other adults. And they will, again, have that 10-year rule to deal with, but that's 10 years of deferred growth. So it's nothing to sneeze at. And during that 10-year period, we can often do things like managing the tax brackets. Maybe in the first few years, our child beneficiary might not be working and be in a lower tax bracket. So maybe we'll take out more during that 10-year, earlier years during that 10-year period. So the things we can do to make it an efficient 10-year period withdrawal. Now, the disadvantages, and this is one of Peter's favorite topics, is we have to be careful here when we do name children as outright beneficiaries. Again, we're talking about adult children. Even with our best laid tax planning and all of the advantages for deferring taxes, some of our children don't pay attention to that. And shortly after you've passed away, there is a red sports car or a kitchen remodel that has to be done, and that child takes a lump sum distribution. So we need to be careful that even when we do all this planning, they may not follow those directions and simply take it all out shortly after you've passed away.
How long after someone dies, Michael, can monies be distributed to them from an estate?
Well, from a trust or estate, it could be a long period of time. There's a lot to do. And so the retirement accounts are often the first accounts that money becomes available. And all that is required to withdraw out of an IRA account, or retirement account, if you're named as a beneficiary, is the death certificate. And that's something like here in Orange County, 7 to 10 days to get a death certificate.
Yeah. So you show up at the institution with the death certificate and a driver's license, and they will hand you whatever amount of monies that you request.
That's right. And as you pointed out in other presentations, sometimes the representative who is handling the request to withdraw money, nor does your beneficiary understand the tax consequences here, and they may not find out until April 15th of the following year when they add a couple $100,000 of income to their existing income and find out that they have a giant tax bill.
Yeah, yeah. It's important discussion to have, especially if you have a larger IRA. Take advantage of that at least 10-year stretch.
Now, the third option is that we can name a trust as a beneficiary. The IRS says if the trust meets certain criteria, that it can be a beneficiary on our beneficiary designation form. And under the Secure Act, in fact, the 250 pages of regulations, the bulk of it was talking about how to do this. And it is kind of a whole new set of rules to name a trust as a beneficiary. But the benefits of naming a trust is that it does provide that missing control, the ability for another person, a trustee, to decide how to allocate, spend the money, withdrawal periods, and all the other things. So we can use a trust to protect the assets from court's creditors and irresponsible spending. And if done properly under the Secure Act, we can set up a trust so that we can provide for spouses or our EDBs, our spouses, minor taxpayer, minor children and grandchildren, minor children and also disabled and chronically ill individuals and individuals not more than 10 years younger than we are. The challenge with this, of course, is that it's not easy to do and sometimes can be very complex. One of our sort of authors in this area is called Life and Death Planning for Retirement Benefits by Natalie Choate. I wouldn't recommend it unless you have insomnia, but she is the authority on it. And one of the things she says is that, look, you better have a compelling reason to do this. And there are compelling reasons. Maybe there's substance abuse. Maybe there's irresponsible spending. We also have to have a sufficient amount of assets to do this because there are negatives about naming a trust. First of all, if you're going to name a spouse, there is no spousal rollover. We can name a spouse, but we can't take advantage of the spousal rollover. Also, the trust must be drafted very carefully under these new Secure Act regulations. And it is likely, because the tax rates are get steeper so quickly in trust, that we will pay higher taxes by using this technique. It also can be administratively complex. Walking into Charles Schwab or Fidelity and telling them that you are the trustee of a trust that's going to own an inherited IRA account, and that person might quit their job that day. So it can get complex and expensive. But if there are compelling reasons, maybe we need to do it. But thought needs to be put into this before deciding to do that.
Yeah. We're going to be talking a little bit about next week about a charitable trust, but a charitable trust doesn't have some of these disadvantages. But again, it takes consideration. You shouldn't just do it. You need to run the numbers, but it could stretch out over the lifetime of a beneficiary, and it may be something to consider, again, depending on your circumstances.
Agreed. Now, this is one of my favorite slides, and that is, we've been talking all morning about how the IRS is going to get their share. Well, the good news is that this is a place where the IRS doesn't get their share. Charities don't pay income taxes. And what we find is I have clients or new clients who come in who sort of have this reversed. And what I mean by that is that they're giving their charities gifts under their trust using money that has already been taxed. And they're giving their children their retirement accounts that all have not been taxed. I'm going to call that the bad money. And what we really want to think about is the potential of swapping that. If we want real tax efficiency, well, we should think about giving our charitable gifts with our bad money out of our retirement accounts and give the children more money out of our trust with would already been taxed from an income tax standpoint. So keep that in mind. Now, if you have a large IRA, we don't have to have all or nothing. I mean, you can break your IRA and have multiple beneficiaries. You could have multiple IRAs with different beneficiaries. So lots of opportunities here to pick beneficiaries and make this as efficient and as possible. Now, responding to the Secure Act, and what I mean by that is that accepting this idea that most of us are going to have this 10-year rule that is going to expedite the distributions and the collection of tax, what can we do about it? Well, in responding to that, we can look and understand, as we've talked about, we just accept the law the way it is, but maybe manage the tax brackets during that 10-year period and take advantage of that 10-year deferral. As Peter just mentioned, the possibility of looking at a charitable remainder trust, which will be discussed next week, has a number of interesting possibilities here that can almost mimic the old stretch. So that's worth looking at. Another response to the Secure Act is I've had some clients contemplate buying life insurance to help pay the insurance on their large retirement accounts. The possibility of maybe doing a Roth conversion. We're going to talk about that in just a second. Remember, Roth conversions, we don't have this tax problem, so that's a possibility. As we just spoke about, we can name a charity as a beneficiary. That certainly cures the problem from a tax perspective. And don't forget, you can do some pretty significant lifetime gifting doing your charitable qualified charitable distributions. And lastly, we can just forget about all the taxes, and you can pull it out and go on a cruise and spend it yourself.
What a concept.
Well,
people are so afraid of having to pay a few dollars in taxes, and so they keep it in there, and then the beneficiary learns that there's a IRA account that's a large sum, because IRAs usually are not discussed in within the family as part of the estate, because you don't know if there's any money going to be there at the time of your death. And so it's always a surprise to the beneficiaries as to the amount of monies that are in there. And a lot of times there's a new kitchen that needs to be done, or a mortgage that needs to be paid off. And then, so sometimes you spending it out of your IRA is on a lower tax bracket, and you can even gift them that monies later. But the idea of spending it and enjoying it or gifting it is something to consider.
Agreed. This is a slide I put together, another important one about mistakes I've seen from people or new clients coming into my practice and asking for assistance. And so keep these mistakes in mind, and hopefully you won't make these same mistakes. The mistake I see quite often, again, not from our clients, but from new clients coming in, is that they didn't name a beneficiary. They left the beneficiary designation blank, or alternative number two, they wrote in the words my estate. I have a case that I'm currently working on where the beneficiary or the owner of the account wrote in the words my estate. And unfortunately, by leaving it blank or writing in the words my estate, you basically effectively wrote a letter that said, I'd like to go to probate court, because unfortunately, that doesn't provide us with any designation at all, and we're at ground zero. We already talked about the idea of not naming minor beneficiaries. We don't want to make that mistake. We also don't want to make the mistake of not naming both primary and contingent beneficiaries. When you look at this beneficiary designation form, there's going to be an area for to write your primary or your first tier beneficiaries and a place to write in our second tier beneficiaries. Unfortunately, we want to make sure we do that because life doesn't always go as planned, and sometimes our primary beneficiary isn't alive. But also importantly, even if all the beneficiaries are alive, primary and contingent, we can do something we call post-mortem estate planning. And maybe we decide that the primary beneficiary doesn't need the money, or maybe they have creditors or other issues, and we want to pass it down to our secondary or contingent beneficiaries. That can all be done after death. So it's important that thought be put into filling out both primary and contingent sections. The other thing about beneficiary forms is we want to make sure we keep them up to date. It is not uncommon for a new client to come in and sit down with me and they have a spouse from 2 or 3 marriages ago named as the beneficiary. So we got to keep those forms up to date. And also importantly, we want to make sure that we're keeping records of our beneficiary designations. Now, the way our firm works is I try to help you complete your forms, and I actually have a schedule that I prepare for you and we attach it. Then what you do is submit them, and then you get a letter back, and we ask our clients to keep those with their important estate planning documents. Now, even if you have your beneficiary designations already done, and you don't have a letter of confirmation, you can simply call up the 800 number and they will send you a letter. There's been a lot of mergers and acquisitions. These forms have been lost, and you don't want to he said, she said after you're gone about what the beneficiary designation form said and where it was on file.
Michael, there was a question regarding an individual who said that they're with Fidelity and they wanted to change the beneficiary designation for their IRA account, and they didn't have a form. They just asked the person to type in the name for the change. What's your thoughts on that?
Well, so Fidelity, well, let me say this, that oftentimes when you make your first request, the company, the institution will say, you can do this online. My preference is to do it by paper, particularly because a lot of times there are more advanced things we want to do with your beneficiary designation forms, and we can't fit them online, and so we need to have the form. So I guess my first piece of advice there is make sure, call back and double check that they don't have a form. I have had that instance, not with Fidelity, but with some smaller companies, and they say, we don't have a form. And if that's the case, then you can do it online. You should still get an update letter from them confirming that it is on file. Don't rely on a printout from your screen. Get something official from the company or the employer.
Thank you.
Okay. Last mistake, and we've already really talked about this, is just make sure that we're really paying attention to these forms when selecting beneficiaries. It's a case-by-case situation. Now, the last part of my presentation with the few minutes that I have is I do want to talk about Roth IRAs because they are quite an interesting legislative creature. And they have a different set of rules. And so all morning, for example, we've been talking about RMDs and required minimum distributions. Well, guess what? Roth IRAs have no RMDs, no required distributions from the owners of the account. So that makes things easy. Also, you can make contributions to these accounts regardless of your age, as long as you have earned income. And this is the most important part. These are not tax-deferred accounts. These are tax-free accounts. That means that in the future, all of your distribution to you and your beneficiaries are completely tax-free. Now, if you do pass away, the IRS lets our beneficiaries inherit these accounts, and they still have up to 10 years to take those accounts out. It's still tax-free, but you can let it continue in that tax-free environment for up to a decade. And we can do spousal rollovers for our Roth account, so lots of flexibility here for our Roths.
I'm amazed that they're still around.
It is an amazing tool.
Yeah.
Now, you're probably saying to yourself, well, I don't want my old retirement account. I'd rather have one of these Roth accounts. Well, the IRS has got you covered on that, because you can do something called a Roth IRA conversion, and you can convert your regular traditional IRAs and other retirement accounts to Roth IRAs. Everybody is eligible to do this. There used to be some income limitations. They took all that away because, quite frankly, the IRS would love for you to do this. And that is because you have to pay the income tax on the conversion to the Roth IRA. And I'll explain that more in a minute. But basically, you have to pay the tax to do this conversion. And with that in mind, careful analysis needs to be done to make sure this makes sense. We're going to talk about some of the factors that you would think about in doing a Roth conversion, and whether you want to do it or not. But I do want to say one thing before we look at the conversions. There is no more what we call recharacterization. If you decide to do a Roth conversion, you're stuck with it. The prior law allowed you to change your mind for a long period of time. That has been eliminated. If you do the Roth, you're stuck with the results and the additional taxes that you must pay. Now, so if you're thinking about doing a Roth conversion, what are some of the things that you would think about, or factors that you would consider in deciding whether this makes sense in a particular circumstance? One of those is, the first one is that maybe you have lower tax rates now, and you think your rate or tax rate will be higher in retirement. Well, if that's the case, maybe it makes sense to try to convert some of this regular IRA money or regular retirement account money into Roth money at what potentially would be a lower rate. Another factor you'd think about is that if you're going to do this conversion, you don't think you're going to need this money for expenses immediately, right? If we're going to convert this to a Roth, we're going to pay the taxes. We want to make sure that it can stay inside that account. You're not going to withdraw it for expenses immediately. That wouldn't make any sense. And sort of tandem to that is that we have to have an investment time horizon that's long enough for us to benefit from this tax-free environment. Again, we're going to pay this tax and convert it, and we want to make sure that the resulting money can stay in this tax-free environment and grow to make this a worthwhile choice. And that gets us to really the most important factor, and that is that you have to be able to pay the taxes on this conversion using what I'm going to call separate money. And what I mean by separate money is that if we're going to do a Roth conversion, I'll give you a hypothetical. Let's say it's going to be $100,000, and we're going to convert that, and we have a tax bill of, let's say, $30,000 to do this conversion. Well, what we want to do is we want to make sure that the full $100,000 ends up in your Roth IRA, not $70,000. And the way we do that is we transfer the full amount from your retirement account into your new Roth, the full $100,000, and the $30,000 tax bill we pay using other money, maybe money from your bank account, maybe money from a trust account, using monies that have already been taxed. And if we can't afford to do that, then you probably want to put the brakes on this transaction. Now, there can be some other estate planning objectives that we want to consider when we're doing Roth conversion, but this will give you a good idea of the things to think about when we are considering doing a Roth conversion. In this area, we do have people we can rely on. Your tax preparers, CPAs, and financial advisors often have software programs where they can put the numbers in and all of the relevant factors and come up with a projection that might help also make this choice. Now, the last slide that I want to talk about is kind of a fun slide about possibility jumpstarting a child's or grandchild's retirement account. And you can open these retirement accounts for young children or young grandchildren. They do have to have their own earned income. So the example I might give is, I don't know, you have a child that works at the ice cream shop and they made $7,000 that year. Well, they don't have to use their own $7,000. You can put your $7,000 into a Roth account. And you can imagine starting these accounts young in a tax-free environment. You get some money in these things going, and they could turn into an enormous amount of money. Now, when you're over 59 and a half, the child would, or benefit, the grandchild would be able to make tax-free withdrawals of everything in these accounts. If they're under 59 and a half, there's lots of interesting options here. They can still withdraw the money without penalty for the money that they've contributed. There are special breaks for withdrawing money for first-time home purchases and educational expenses. And interesting, under the Secure Act 2.0, this is a brand new rule. If you've got some 529 accounts that you didn't use up for paying for college and other expenses, you can roll those over into a Roth account. There is a $35,000 limitation, and the accounts have existed for a certain amount of time, but a really interesting idea for leftover 529 money. So all of this planning is great, and we can turn our children and grandchildren into millionaires with tax-free money, just like Peter Thiel. But the problem is, remember, that child or grandchild is going to have control of these accounts when they turn 18. And again, our best laid plans to turn them into millionaires might get lost on a Toyota Corolla at age 18, and the money's all gone. So,
yeah, we've done this. Is that it seems like anyway, for grandchildren or kids, is that if they feel that they've earned the money, they're more considerate in saving the money. If they think it's a gift, then people treat it differently. So what we have done is that we make sure that when we give our grandchildren monies, it's because they've earned it.
yes.
So
I agree with that. And also a real interesting opportunity to spend time with a child or a grandchild and picking investments and getting them interested in that, and a sense of ownership of it would negate the possibility of them pulling it out because they're quote unquote invested in it and the choices they made.
Yeah. It's a great education.
All right, well, that's my last slide. And today we really focused on one aspect of, or component of, estate planning, and that's the retirement accounts. I hope after today's presentation, you see how important it is and how it fits in with the rest of your estate plan to make one successful estate plan. And with that, I'm going to take my presentation down, and I'm happy to stick around and take additional questions.
All right. Thank you very much, Michael, for this great presentation. Thank you everybody for watching. We're about to start the live Q&A. For all the people watching, the next class is going to be Charitable Opportunities with David Moore from Chapman University. Again, stay with us, people, for the live Q&A. Anybody watching, thank you for watching. We'll see you in the next class.